Welcome to the Deep Dive. We're here to really unpack complex topics, pull out the key insights, and basically give you a shortcut to being genuinely well-informed. Today, we are plunging right into the securities industry, specifically its rules on conduct and reporting. Think of it like uncovering the hidden wires, the rules that shape the financial markets, and, ultimately are there to protect you. Our mission today, pretty clear. We're going to boil down the essentials for materials like securities industry conduct and reporting requirements. We want you to get how transparency and accountability are built into this system. We'll cover how pros get registered, what they absolutely have to tell you, how complaints work, and even some surprisingly strict rules about gifts and political donations too.
Absolutely. And this isn't just for Wall Street insiders. This stuff is, well, it's crucial for anyone interacting with the markets. Maybe you're an active investor, maybe you're just planning your retirement, or maybe you're just curious about how this massive industry is supposed to stay honest. It's not just knowing the rules, it's understanding why they're there, how they protect you.
Okay, let's dive in, starting right at the beginning. Becoming a registered representative. Basically, nearly anyone doing securities business for a member firm needs to register. Unless, I suppose, their job is purely clerical.
Exactly. Purely administrative, back office stuff, usually exempt. But for anyone else, registration is key. And before that even happens, the firm has to do its homework. They investigate the candidate's good character, business reputation, qualifications, and experience. It's a pretty serious background check.
Right, it's not just a rubber stamp.
Not at all. And the main tool for this is Form U-4. That's the Uniform Application for Securities Industry Registration or Transfer.
U4, okay.
Yeah, and this form is the gateway. It collects all the basics, personal data, where you've lived, where you've worked, but crucially, it asks pointed questions about any past violations, any run-ins with the law or SRO rules, like has the SEC ever issued an order against you related to investments? The U4 wants to know.
So it's more than just a resume.
Oh, much more. Page 3 gets really specific. It asks about criminal history felonies, naturally, but also misdemeanors if they're related to securities. It covers regulatory actions, civil court cases, past customer complaints, even things like terminations from jobs or financial difficulties like bankruptcies or liens. They want the full picture.
And filling this out incorrectly, I imagine that's a big problem.
A huge problem. Submitting false, incomplete, or, misleading information, that can get your registration suspended or even revoked. And if you deliberately fail to disclose something important, you could find yourself barred from the securities industry permanently.
Wow. Barred for life, that's serious.
It absolutely is. And typically, if you answer yes to one of those violation questions, you have to explain it in detail on what's called a disclosure reporting page, or DRP. It's part of the U4. A yes answer can often lead to something called statutory disqualification.
Statutory disqualification. Okay, what does that mean in practice? Can you still work?
Well, it means you're potentially barred, but there's a path. A disqualified person can apply for a waiver from an SRO, like FINRA. This involves an eligibility proceeding. If the SRO grants the waiver, they have to tell the SEC. And the SEC can actually step in and overturn that waiver.
So multiple layers of review.
Right. And if you do get the waiver, you're usually placed under enhanced supervision by your employer. It's spelled out in their procedures. Generally, you can't work for a member firm until that waiver is granted. Though, if you're already employed when disqualified, you might be able to continue in a limited capacity while it's reviewed.
Now, something else in this U4 form that's really interesting and maybe not widely known is the pre-dispute arbitration clause.
Ah, yes. That's incredibly important. And firms have to be very clear about what it means when you sign. Essentially, by signing the U4, you're agreeing to arbitrate most disputes you might have with your firm, with customers, with other registered individuals.
So you give up the right to sue in court.
In most cases, yes. You give up the right to sue in court, and specifically, the right to a jury trial. There are key exceptions, though. Employment discrimination claims, including sexual harassment claims. Fin and Raw rules state you don't have to arbitrate those unless you agree to after the dispute arises.
Okay, that's an important carve-out.
It is. Same goes for disputes under whistleblower statutes. Arbitration isn't mandatory unless agreed upon post-dispute. But for most other things, like disputes over trades or account handling, arbitration is the default path.
And what does that mean practically? How is arbitration different?
Well, firms have to disclose this clearly. Arbitration awards are generally final and binding. Courts have very, very limited power to review or change them. The process for discovery, getting documents, questioning witnesses, is usually much more limited than in a court case.
Less formal, perhaps.
Less formal, maybe faster. but definitely different. And arbitrators usually don't have to explain their decisions unless everyone agrees beforehand to ask for a written explanation. The panel deciding the case might include arbitrators from the industry itself alongside public arbitrators, and there are time limits for bringing claims. If a claim is too old for arbitration, you might still be able to take it to court.
So for someone entering the industry, the big takeaway is this is a comprehensive vetting process, and you're agreeing up front to a specific way of resolving disputes.
That's a great summary. It's a thorough check, and it fundamentally shapes your legal recourse within the industry. It's efficient, yes, but different from the court system you might expect.
Okay, so you're registered, the U-4 is filed, but it's not like the scrutiny ends there, right? How does the system keep track of people over time?
Exactly. It's an ongoing process. All this information lives in the Central Registration Depository, the CRD. Think of it as like the industry's central database for everyone's employment and disciplinary history.
The CRD. Got it.
And firms have ongoing duties. When they hire someone new or someone transfers, they have to review new hires. They need to check that the U-4 is accurate and complete within 30 days of filing it. And if the person was registered before, the new firm has to get and review their latest Form U-5, that's the termination notice, from their old firm within 60 days of the application.
And the applicant has to hand over that U-5 if asked.
Yep, within 2 business days if the firm requests it. It's all about maintaining that chain of information. And critically, the U-4 isn't static. There's an ongoing duty for updating Form U-4. If a registered person is convicted or even just charged or pleads guilty or no contest to any felony or certain specific misdemeanors.
Like investment-related ones?
Exactly. Investment-related, fraud, theft, bribery, forgery, things like that. The U-4 has to be updated promptly. That means within 30 days.
What about just an arrest, if someone's arrested but not charged?
Good question. An arrest without charges doesn't technically require a U-4 update or reporting to FINRA, but many firms have their own internal policies that require employees to notify them of arrests anyway, so the firm might know even if FINRA doesn't yet.
Okay, that makes sense. Now, you mentioned Form U-5, the termination notice. What happens when someone leaves a firm?
Right, so when a rep resigns or is terminated, the firm must file Form U-5 with FINRA within 30 days. It has to state the reason, voluntary, involuntary termination, etc., and they must give a copy to the former employee.
And this U-5 can be updated later?
Yes. If the answers to certain questions change after the person has left, maybe new information comes to light. The firm has 30 days to file an amended U-5.
And here's a crucial point. If a written customer complaint comes in after the representative has left the firm still has to report it to FINRA via an updated U-5 or other means. Doesn't matter how long ago the rep left.
Wow, even years later. Doesn't matter, the obligation remains. Though the firm isn't required to send a copy of that late arriving complaint to the former rep. Another key thing. FINRA keeps jurisdiction over someone for 2 years after their U-5 is filed.
Why is that important?
It means if you leave the industry but decide to come back within that 2-year window, you generally don't have to retake your qualification exams. After 2 years, you typically do.
Okay, that 2-year window is significant. Now, how does the public see any of this? You mentioned the CRD database, but is that accessible?
Well, the CRD itself isn't directly public, but FINRA runs a public disclosure program called BrokerCheck, and there's also Form U-6.
Okay, 2 things there. U-6 first.
Form U-6 is what regulators, states, and FINRA use internally to report disciplinary actions and final arbitration awards against reps and firms. It feeds into the system, but for you, the investor, the main tool is BrokerCheck.
BrokerCheck, heard of it.
You can access it online on FINRA's website or even call a toll-free number. It gives you the disciplinary history for firms and for reps who are currently registered or have been within the last 10 years.
What kind of information is actually on BrokerCheck?
Quite a lot, actually. It shows their current firm employment history for the past 10 years, what licenses or registrations they hold, and importantly, it details certain legal and regulatory issues, felonies, specific misdemeanors, civil cases related to investments, regulatory actions against them. It also lists pending customer arbitrations or lawsuits over a certain size, final awards or judgments against the rep, and settlements of $10,000 or more related to investment activities.
What about complaints that don't go to arbitration?
Yes, written customer complaints filed within the last 24 months alleging sales practice violations and claiming damages of $5,000 or more are listed. It also shows if they're under formal investigation by regulators or if they were terminated from a job after allegations of things like fraud, theft, or failing to supervise.
Transparency, a powerful tool for due diligence.
Absolutely, it's designed to be.
But what if something on broker check coming from the CRD is just wrong? Can it be fixed?
Yes, there's a process. If the information came from an arbitration case, there's a specific and quite difficult process called expungement. FNRA allows expungement from the CRD record only under very specific circumstances, such as the claim or information is factually impossible or clearly erroneous, or the registered person was definitively not involved in the alleged misconduct, like the sales practice violation, forgery, whatever it was, or the claim itself is proven to be false.
So a high bar to clear.
Extremely high. It usually requires a court order confirming one of those grounds. But if information is expunged, it's permanently deleted. It vanishes from broker check. Regulators can't see it. Future employers can't see it.
Okay, that makes sense. Let's shift focus a bit from the individual's record to the firm's responsibilities. How do firms handle complaints internally, and what does reasonable supervision actually look like?
Good question. First, what counts as a complaint? It's defined broadly. Any written statement, and that includes emails, even texts now, from a customer alleging a grievance. It has to involve someone under the firm's control and relate to handling securities, funds, or transactions.
So any written grievance, what happens then?
The original complaint has to go straight to a supervising principal. They review it, initial it, and firms must keep a dedicated file of all written complaints at each office location. This file has to be kept for 4 years.
What's in the file?
The complaint itself, records of any actions taken in response, related correspondence, everything. Even if they get no complaints, they still need to maintain an empty file ready. Responses, by the way, can be written or oral.
Okay, that's handling individual complaints.
Yeah.
But what about bigger issues? What events trigger a mandatory report from the firm to Chukanora?
Right, these are reportable events. Firms usually have 30 calendar days after discovering them to report to FINDAR. It covers serious stuff, like if the firm or an associated person is subject to a written complaint alleging theft, misappropriation of funds or securities, or forgery.
Okay, direct allegations of serious misconduct.
Yes. Also, if the firm or a person is found to have violated securities laws or regulations or industry standards, or if they're denied registration, expelled, hit with a cease and desist, suspended, disciplined by any regulator, being named as a defendant by a regulator alleging securities violations is reportable.
What about criminal or civil matters?
Definitely. If an associated person is indicted, convicted, or pleads guilty or no contest to any felony, or those specific misdemeanors we talked about earlier, securities-related, bribery, theft, fraud, etc. Also, if they hold certain positions, like director, controlling owner, in a financial entity that gets suspended, expelled, or has its registration revoked. And there are financial thresholds, too. If an associated person is involved in a civil case or arbitration that results in an award or settlement over $15,000, that's reportable. For the firm itself, the threshold is $25,000.
15 for the rep, 25 for the firm. Got it.
And finally, if the firm takes internal disciplinary action against a rep suspension, termination, withholding commissions, or imposing a fine over $2,500, that also needs to be reported.
So a pretty wide net for serious issues.
It is. And beyond these specific events, firms also have to file quarterly reports. These provide statistical and summary data about customer complaints received during the quarter. They're due by the 15th of the month after the quarter ends. If a firm had 0 complaints in a quarter, though, no report is needed for that period.
What about confidential settlements? If a customer settles a complaint but agrees to keep it quiet.
The terms might be confidential for the customer, but the registered person involved still has to report the relevant details of the settlement event to the CRD system if it meets the reporting criteria we just discussed. Confidentiality for the customer doesn't erase the regulatory reporting requirement.
This brings us nicely to this idea of red flags and reasonable supervision. It sounds like supervisors need to be pretty proactive.
Absolutely proactive. The SEC really stresses this. It's not enough just to have written supervisory procedures, WSPs. Supervisors have to actually follow them and actively look for trouble spots. They need to be trained to spot red flags, those warning signs, maybe unusual trading patterns, frequent errors, client unease signs that could indicate potential violations even if the full picture isn't clear yet.
So like financial detectives within the firm.
That's a good analogy. And when a supervisor does spot a red flag, there's a required 3-step process.
Okay, what are the steps?
1. Investigate. Gather the facts, review documents, talk to people involved. And crucially, regulators often want to see that supervisors are actually talking directly to the clients of the reps they oversee. 2. Document. Write everything down. What documents were reviewed, who was interviewed, any client contacts. This written record is vital if regulators come asking questions later. 3. Follow through to a conclusion. The investigation needs to be resolved even if it turns out no violation occurred. Document the outcome. And the investigation needs to be objective. Look beyond just the employee's explanation. Consider their past conduct. Often, poor communication is at the root of issues that could escalate, so early intervention is key.
Investigate, document, follow through. Clear framework. Okay, let's pivot slightly. How does the system regulate the personal activities of employees to prevent conflicts of interest, things outside their day-to-day client work?
Right, this is important too. First, outside business activities, or OBAs. Registered reps have to give written notice to their employer before they engage in any outside business, even a weekend side job, like, say, driving for a ride-sharing service or starting a small online store.
Why? What's the concern?
Conflicts of interest. Imagine a rep serving on the board of directors of a public company. If their firm is also recommending that company's stock, that's a potential conflict, right?
Definitely.
So the firm needs to know about these outside roles to assess potential conflicts. The main exception here is usually unpaid volunteer work or charitable activities. Those typically don't require notice.
Okay, that makes sense. What about private securities transactions? Sounds like something done on the side?
Exactly. These are securities transactions done outside the normal scope of the rep's job with their firm. Maybe helping a friend raise capital for a startup or selling interests in a private deal. The rule is the associated person must notify their employer in writing before participating. Doing these transactions without telling the firm is called selling away, and it's strictly prohibited.
Selling away.
Got it.
Prohibited.
Right. Now, if the rep is going to get compensated for this private transaction, could be commissions, finder's fees, even stock in the venture or tax benefits, the firm not only needs notice, but they have to approve it in writing. And if approved, the transaction has to be recorded on the firm's books and records and supervised by the firm.
What if there's no compensation involved? Just helping out a friend.
Still requires written notice to the employer. The employer then has to provide written acknowledgement back, and they might impose certain conditions on the rep's participation. There are some exceptions. Personal transactions in mutual funds or variable annuities generally aren't covered by this specific rule.
Okay, now for something maybe more relatable gifts, we all give and receive them. But you mentioned strict rules here.
Yes, surprisingly strict. It's called the gift limit rule, officially about influencing or rewarding employees of others. The rule says, FINORA member firms and their associated persons cannot give gifts valued at more than $100 per year to any individual employed by another firm if the gift relates to the business of the recipient's employer.
$100 per year per person at another firm related to business. Why so specific?
The concern is improper influence. Could a lavish gift make someone at another firm favor the giver, perhaps against their own employer's or client's best interests? The $100 limit tries to keep gifts nominal. Importantly, this limit doesn't apply to gifts within the same firm. An employer can give their own employees gifts above this amount.
How do you figure out the value if it's, say, tickets to a game?
Good question. Generally, it's the higher of the gift's cost or its market value. For group gifts, like a gift basket, you divide the total value by the number of recipients. So a $200 basket for 4 people is $50 each, under the limit. Tickets, like for sports or concerts, are valued at the greater of their cost or their face value. So if a ticket costs $90 but has a $50 face value, it's valued at $90 for the gift limit.
Okay, higher of cost or face value for tickets. Are there any exceptions to this $100 rule?
Yes, several important ones. Personal gifts for occasions like a wedding, birth of a child, or maybe significant life event. Those aren't subject to limit if they're truly personal and not related to business. De minimis gifts, very small items like pens, notepads, maybe a small desk ornament, are usually okay. Promotional items with the firm's logo, like umbrellas or tote bags, are also excluded if their value is considered significantly below $100.
What's significantly below? Is there a number?
Yeah. They don't give a hard number, unfortunately, which can be tricky. But think clearly less than $100. And commemorative items, like a lucite plaque marking a deal closing, are also generally excluded.
What about taking clients out? Dinner, golf, that sort of thing?
That falls under business entertainment, and it's excluded from the $100 gift limit, but with 2 key conditions. 1, it can't be so frequent or lavish that it raises questions of impropriety. And 2, the member firm's representative must host the guests. They have to accompany and participate in the event.
Ah, So you can't just give clients tickets and send them on their way.
Exactly. If you just give them tickets and don't go with them, that's a gift, and the $100 limit applies to the ticket value. If you go with them, host them for dinner or the game, it's considered business entertainment and generally okay, provided it's reasonable.
That hosting requirement is key. Okay, let's talk compensation structures. How are reps paid, especially when different products or firms are involved?
Right. This area, member compensation related to the sale of securities products, has rules to prevent conflicts too. For example, a firm that creates mutual funds generally can't pay reps at another brokerage firm using its own securities, like stock or options. More broadly, reps are usually prohibited from receiving compensation cash or non-cash for selling certain products like DPPs, REITs, mutual funds, variable contracts from anyone other than their own brokerage firm.
So the product company pays the brokerage firm and the firm pays the rep.
Precisely. A mutual fund distributor can't pay a rep directly for selling their fund. They pay the rep's firm, and the firm pays the rep through their normal compensation structure. Cash compensation is broad commissions, fees, loans, bonuses. Non-cash includes merchandise, gifts, prizes, travel, meals, lodging tied to sales.
But are there exceptions here too? Can reps accept anything from product sponsors?
Yes, there are some de minimis exceptions that align somewhat with the gift rule. Reps can accept gifts up to $100 per person per year from folks associated with, say, a mutual fund company or a variable annuity issuer. Occasional meals or tickets are also generally acceptable, provided they aren't excessive and not directly conditioned on hitting a specific sales target. It can be recognition for past sales or encouragement, though.
What about training events? Sometimes product companies host those.
That's covered by the training and education exception. Product sponsors can pay for or reimburse reps for attending meetings focused on education. But there are conditions. The rep's broker-dealer has to give permission. Attendance can't be tied to achieving a sales quota. The location must be appropriate, not a resort getaway disguised as training. And crucially, they can't pay for guests like spouses to attend.
Keeping it strictly business and educational.
Exactly. And finally, firms can run their own in-house incentive programs. They can offer non-cash rewards like merchandise or trips. They can even accept contributions from product sponsors to help fund these internal programs. But again, conditions apply, especially for mutual funds and variable annuities. The program must be based on the rep's total sales across all similar products the firm offers, not just one specific fund family. And the incentive credits have to be weighted evenly across those products.
So you can't create an incentive to push one fund over all others.
That's the idea, promoting broad product sales, not specific ones due to skewed incentives.
Okay, last major area, rules around political contributions. This seems important for maintaining market integrity, especially with municipal bonds.
Very important. This is the MSRB's political contribution rule, known as Rule G37. Its main goal is to stop pay-to-play. That's where firms might make large political donations to elected officials hoping to win municipal securities underwriting business in return.
So preventing quid pro quo deals.
Exactly. A political contribution is defined very broadly: gifts, loans, paying off debt, covering campaign or inauguration expenses, anything of value. The rule primarily targets municipal finance professionals, or MFPs.
Who counts as an MFP?
It's generally associated persons whose main job involves municipal securities, business underwriting, trading, sales, financial advisory, research, investment advice related to munis, or anyone who solicits muni business from issuers. Reps who only deal with retail customers usually aren't MFPs unless they also solicit business directly from issuers.
And what's the consequence if this rule is violated?
It's significant. If a municipal securities dealer or its MFPs makes certain contributions to officials of municipal issuers, like mayors or governors who can influence bond deals, the firm is banned from doing any negotiated underwriting business with that issuer for 2 years.
A 2-year ban. That's a serious penalty.
It is. It directly hits the firm's potential revenue.
Is there any way for an MFP to contribute without triggering the ban?
Yes, there's an exception. An MFP can contribute without causing the ban if 2 conditions are met. 1, the MFP must be entitled to vote for that official. And 2, the contribution can't exceed $250 per election, primary and general count as separate elections.
$250 per election, if you can vote for them.
Okay. That $250 is the de minimis amount that's allowed. Anything over that, or a contribution to an official you can't vote for, triggers the ban for the firm.
What about trickier situations?
Yeah.
Like if an MFP makes a contribution, then leaves the firm. or contributions from spouses.
Yeah, the MSRB has clarified these. If an MFP makes a contribution over $250, triggering the ban for Firm A and then leaves, that ban stays with Firm A for the 2 years. Now, if that same MFP joins Firm B as an MFP, Firm B also becomes subject to that same 2-year ban with that issuer.
Wow, the ban follows the person if they stay in MFP.
Correct. However, if they join Firm B in a role where they are not an MFP, then Firm B is not subject to the ban. And spousal contributions. If the contribution comes from the spouse's separate funds and account, it's not attributed to the MFP and doesn't trigger the rule. But if it comes from a joint account, it usually gets attributed at least partially, potentially triggering the ban if the MFP's share exceeds $250.
Fascinating how detailed that is. Okay, we've covered a huge amount of ground registration, reporting, complaints, conduct, gifts, contributions. Let's bring it back home. How does all this help the average investor, the listener?
It really comes down to transparency and protection through information. FINRA has an investor education and protection rule. It requires firms to give their customers at least once a year specific information in writing or electronically.
What information?
The broker check hotline number, the FINRA website address, and a statement telling them that an investor brochure describing broker check is available. It's about making sure you know this tool exists and how to access it.
So, an annual reminder about broker check?
Exactly. Though firms that don't hold customer accounts or funds are usually exempt. And the MSRB has a similar investor education rule for the municipal security side. It requires dealers to annually disclose their MSRB and SEC registration status, the MSRB website address, and the availability of an investor brochure on the MSRB site. That brochure explains the protections under MSRB rules and how you can file a complaint. This used to be information you only got when filing a complaint. Now it's an upfront annual disclosure.
Empowering the investor with information proactively.
That's the goal, giving you the tools and knowledge to navigate the system safely.
Wow. Okay, that really was a deep dive. We've journeyed through this really complex regulatory world designed to keep the securities industry fair and transparent. It's pretty clear just how much detail goes into vetting professionals, keeping their records straight, and policing their conduct day to day.
Absolutely. From that very first Form U4 application through the ongoing reporting, the complaint handling, the specific rules on gifts, even down to political contributions, it paints a picture of an industry striving for, accountability and investor trust.
So here's something to maybe chew on after this. We've seen this incredibly detailed system for disclosure and conduct in finance, especially with tools like BrokerCheck making so much public. Where do you think the next frontier for this kind of transparency might be? Are there other industries, other areas of our economy that could benefit from a similar level of public oversight and detailed rules? And how might that change things for you as a consumer or investor? Definitely something to think about. Thanks for diving deep with us today. Until next time, keep asking questions, keep digging deeper.